Warning, the following ZipRecruiter radio spot you are about to hear is going to be filled with F-words.
When you're hiring, we at ZipRecruiter know you can feel frustrated, forlorn even, like your efforts are futile, and you can spend a fortune trying to find fabulous people, only to get flooded with candidates who are just fine. Fortunately, ZipRecruiter figured out how to fix all that. And right now, you can try ZipRecruiter for free at ZipRecruiter.com/zip. With ZipRecruiter, you can forget your frustrations because we find the right people for your roles fast, which is our absolute favorite F word. In fact, 4 out of 5 employers who post on ZipRecruiter get a quality candidate within the first day.
Fantastic.
So, whether you need to hire 4, 40, or 400 people, get ready to meet first-rate talent. Just go to ZipRecruiter.com/zip to try ZipRecruiter for free. Don't forget, that's ZipRecruiter.com/zip. Finally, that's ZipRecruiter.com/zip.
Valuations are at record levels. Can they keep going higher?
There is a level of complacency in the market right now, and we are starting to see that, particularly with retail investors to some extent. We're seeing it with other indicators where the volatility levels are pretty low and people are just kind of riding the wave. And that worries me to an extent. But at the same time, it's hard to ignore the fundamentals. And people will ask me often, hey, are you worried about the valuation of U.S. equities? Yeah, I am. But at the same time, I look at, is this another tech bubble or is this another pre-financial crisis? I don't think so.
That's Nate Thooft, Chief Investment Officer at Manulife Investment Management. And he says that valuations are a terrible market timing tool, so you don't want to use them as a signal on what to do now. He thinks the market can keep rolling, though he has his concerns, and he'll explain them in the big interview. Nate's batting cleanup today. Leading off, Todd Rosenbluth, head of research at Vetify, here with the ETF of the week. Then, I answer a listener's question about buying a new car versus going used. He thinks it's impossible to get the value out of a new car. I don't think so, even though I myself drive an old beater. And then Mark Hamrick, Washington Bureau Chief and Senior Economic Analyst at Bankrate.com, is here discussing their latest retirement savings report, which found that 60% of workers are behind on their retirement savings.
Abandon all hope, ye who enter here.
No, it's not that bad. No, really. I promise. Even if it's 60% say they're behind on their retirement savings, we'll talk about how their methodology is flawed. And yeah, valuations are high, but there's not crashing too. Hope. Yes, we want you to have hope. This is Manulife for September the 25th. I'm your host, Chuck Jaffe, and I hope we've got a great show that we have executed for you today, because that lineup is really good. Todd Rosenbluth with an interesting fund that puts a spin on things that we haven't really discussed on the show before. The question is a really good question. It's not one that I'm necessarily living, but I did mention the fact that there's going to come a point where Gail and I, we are considering, when will we replace my car and how will we replace my car? The listener who wrote the question about it kind of picked up on that from an interview we did at FinCon, where we were talking with a guy who runs a service about leasing cars. So I think it's an interesting question. And those are the subjects, we do plenty of personal finance. And I recognize that sometimes you won't know what you want to hear until you hear it. Like, oh, I really liked that. But you can encourage me to do more of that, because I love doing that stuff, whether it's the things that were coming up with warranties. When I talked about the warranty with my chair, a number of you were like, I really appreciate that discussion. And I'll point out, Gail and I just bought a new stove because our stove had pretty much died. And there was a question about a warranty there, and would we purchase one? And I'll say, when I replaced my chair, much smaller dollar value on the item, we did buy the warranty because, well, historically would show that I would need it. When we bought the stove, while we still have time to do it if we want to change our mind, we did not buy the extended warranty. If you want us to get into some of that stuff more often, please let me know what you want us to talk about. But what we're maybe most known for is the market stuff. And Nate Thooft, great interview here today. We're just going to jump in today's show because it's a great lineup and I want to let it run and get you as much talk as we can. Todd Rosenbluth, me answering a question, Mark Hamrick, Nate Thooft. The ETF of the week gets us started right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at VettaFi, and VettaFi.com has a full suite of tools and information that's going to make you a better investor in ETFs. So check it out at VettaFi.com. Todd Rosenbluth, it's great to chat with you again.
It's great to be back.
Your ETF of the week is
The Fidelity Investment Grade Securitized ETF, FSEC.
FSEC, the Fidelity Investment Grade Securitized ETF. We have to explain a little something here, Todd, because investment grade, everybody understands what we're talking about, but securitized, not so much. So help explain the fund and then why it's the ETF of the week.
Yeah, so let me just make sure people are on the same page with me and hopefully you about what securitized debt is. So these are mortgage-backed securities or asset-backed securities or commercial mortgage-backed securities, CMOs. There's a whole bunch of acronyms that get used in this space. Pretty much, if you own a bond ETF or a bond mutual fund, you own treasuries and investment-grade corporate bonds primarily. The rest of the ETF or the mutual fund is made up of these securitized debt securities. We think this is a compelling space. In fact, many of the audience that we had at a recent VettaFi symposium also found this to be a compelling space, as well as active managers. So Fidelity has one of the larger, more popular ETFs in this space with FSEC. So we wanted to dive a little bit closer and have you understand, the audience understand what this fund is and why this can be compelling now that the Fed has cut interest rates.
And we need to explain to people that if you like what you hear, whether it's the Fidelity Fund or others, there are not that many in this. There are plenty of funds in the investment grade space, but this specific type of thing, yes, you are looking for securitized, and it is not the same thing. Does it perform differently? Like, do investment grade securitized holdings perform different than investment grade corporate bonds that you hold without having, to put together a bunch of things to make a security?
So yes, these are going to perform differently, or this ETF is going to perform differently than investment grade corporate bonds. The corporate bonds are going to be tied more towards credit risk and how comfortable people are in taking on credit risk, as well as the bottom up individual securities, whereas securitized is going to perform differently. I want to also clarify, there are some ETFs that are out there that are targeted, and you can get an ETF that's focused just on mortgages or mortgage-backed securities or asset-backed securities. I think you can get that as well. This being the FSEC, the Fidelity Fund, gets you the benefits of active management in sorting through a broad, diversified universe of securitized debt. And we had one of the portfolio managers from this fund on the symposium, and he used a statistic that blew my mind. There are 2 million of these individual securities that he and the team could be potentially choosing from. So that's how you get benefits of active management in a team that is looking for the best reward without taking on as much risk within a portfolio.
Because of that kind of market and the way that market is structured, a fund like this will typically have a little bit higher turnover than an investment grade fund that somebody's looking at. And it may have a higher expense ratio as a result because managers need to do it. So you're obviously not worried about those things, but like, what is this fund yielding so that people understand what you might expect to get in yield for this?
So I believe the last I looked, the fund was yielding roughly 4.5%. It might have shifted a little bit. You're right about turnover. There's going to be turnover. I'm not concerned about that. Within the ETF's wrapper, you're not paying the same level of capital gains the way that you would with the turnover of a mutual fund. In fact, I'm looking at the website right now, and this was, again, February of 2025. It's done on an annual basis, and the turnover is over 1,000%. No, I don't believe that's a typo. That's just what's on the fact sheet. That's not something that you should be concerned with. You are paying a fee for active management, and so that's something you should be mindful of, that is going to be a higher fee than what you'd find for an index-based product. We think you're getting rewarded for having the active management and the strength of Fidelity's active management capabilities. And I just want to throw out there, we've talked about active ETFs, but people may wonder, why does Todd keep coming back with an active fixed income ETF? Maybe that was your next question, Chuck, and I stole that from you. We're seeing demand for active fixed income ETFs in 2025. We've been seeing it for the last couple of years, but they're really punching above their weight as the heavyweights within the space bring some of their best management into the ETF wrapper. So the team behind FSEC also supports the mutual funds. They're now here, and they've been for a few years in the ETF space. That's just a great thing for many investors.
I want to clarify the expense ratio. While the active management makes it higher than other things in the space, it's still in this case only 0.36%, so 36 basis points. So it's not an expensive fund to own. Where does this fit in a portfolio? Because the obvious thing would be take your investment grade securities and give a piece over to something that's securitized as opposed to just holding the standard basket if you want to do that. Or if you already have an investment grade fund, will it hold enough securitized investments, even if it doesn't specialize in them, that you don't need to double up? You only want this if you're looking for investment grade addition to the portfolio.
So I agree with the first use case in that if you had targeted exposure to investment grade corporate bonds, for example, given where credit spreads are, you might find this to be a nice alternative or complement to that. We find that many people, they're getting their fixed income exposure through an aggregate bond-based strategy, whether that's AGG from iShares or BND from Vanguard. Those are index-based ETFs, fixed income ETFs. If that's your fixed income exposure, then you have relatively low exposure to a securitized debt relative to treasuries and corporate bonds. And we think this can be a nice complement to that. I don't imagine that many people are building their own bond allocations and having slices to individual segments. They have a certain percentage towards treasuries, a certain percentage towards corporates, a certain percentage towards securitized. But if you were doing that, this is a strong fund within that space. So multiple use cases.
Last question on this. I mean, obviously we just saw the Fed start to enter what we expect is going to be a rate cut cycle that's going to last for a little while. How would anybody expect securitized investment grade securities to perform in a rate cut cycle? And you would expect them to ride along with the rate picture for everything else, but better, worse, is there any indication?
So I'm not that knowledgeable to be able to tell you that is going to be an outperformer or a stronger performer. I do know that many people have been hiding out in short-term treasuries, and those are already yielding less. They're going to likely continue to yield less than they would as the Fed cuts interest rates. And so we're seeing people willing to take on investment grade but high quality exposure. And I think you can get that within the securitized space quite nicely.
It's FSEC, Fidelity, investment grade securitized. It's the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. We'll see you again next week.
See you next week, Chuck.
Todd Rosenbluth is head of research at VettaFi. You can go to VettaFi.com for more information. Use their resources to make yourself a better investor in ETFs. And of course, Todd and the ETF of the week start us off every Thursday on Manulife, and we are just getting started. Later, Nate Thooft from Manulife Investment Management will be here for the big interview. We got Mark Hamrick from Bankrate.com coming in too. But next, I'm going to answer one of your questions. You question what it is? Let's stick around and find out.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Anybody have any questions?
I'd like to ask you some questions.
Oh, you can ask questions.
Any questions?
Remember, there are no stupid questions, just stupid people.
Well, there certainly are no stupid questions here on Money Life. We love getting them from you. Thanks so much for sending them. Chuck at moneylifeshow.com is where you would send them if you got a question for me.
I'm sorry, but all questions must be submitted in writing.
And today we are asking a question or answering a question about cars. And frankly, it's a good question. Let me know if you've got one similar. This one comes from Phil in Wesley Chapel, North Carolina. And he says, Chuck, my wife wants us to buy a new car. And she means a brand new car, like brand new off the lot. I've always bought used cars. I don't like how you never get your value, how you drive off the lot and the car depreciates so much right away. I know you drive used cars because you've said it on the show, but in the FinCon shows, you talked to the guy about leasing and his leasing service, and you said you might lease your next car. Was that because you had that guy on as a guest and he was talking about leasing, or are you serious? I'm a little bit younger than you. I'm still in my 50s, and it just seems like buying a brand new car or even leasing one is a waste when I can buy a good used car and get the value out of it and then upgrade it. Change my mind. And that, again, is, I said Phil, Pete in Wesley Chapel, North Carolina. Sorry, Pete. So, yes, Pete, I did say I was considering leasing. No, you should not let that drive you off the road or anything else because it's not that kind of a thing. But I am making decisions because I do drive an old beater. I say all the time that I drive a Volkswagen box, an over 20-year-old Volkswagen that doesn't have much mileage on it because I don't drive very much. And because I don't drive very much, that is in fact why I would consider leasing a car, et cetera. So let me just point out, when it comes to buying a car, everyone wants to go to that, oh, you get depreciation and it's terrible. I can get into the arguments about buying versus leasing. And if you guys are interested, let me know and I will do more on it. I'm going to try to answer this question and not necessarily go all the way. And if I wind up making the car decision, which I will at some point, it's not a rush for us, then I'll do more on it. But just for the record, typically the best deal, you want to get the most money for your value on a car, you buy that car, keep that car until it becomes economically unfeasible to keep fixing it. That is typically the best way to do it. So you're right. If you drive the car off the lot and you get into an accident, the car is depreciated dramatically when you get off the lot. But if you buy that car and you don't get in an accident and you keep that car for 15 years, then you got your depreciation out of it. You got all of the value out of it. So in my case, because I have been driving old beaters and because Gail's at a spot where if we upgrade one car, we'll let the other one then become the next old beater, if you will. And her car is not as old as mine, but it's not new by any stretch of the imagination. And it would be just fine for one of us to keep driving. I'm looking at it differently. The question would be, would I buy a new car and go, in my 60s, this is probably the last car I will buy because I would keep it for so many years? Because I drive, given that I work from home, et cetera, I drive less than 6,000 miles a year most years. Now, if you give me a newer car, we'll probably take that car more often. But I'm not going to be the guy who has a problem with a lease where I'm running over the mileage quotient. If we were to say, oh, you've got this new car, does Gail want to take it when she's driving into Boston, which she does a couple times a week? You could do that. Then you want to make sure you're, not getting to where you're going to have a mileage problem on the lease. Now, if you don't use the miles that you're paying for, that may not be good value. So you want to understand lease terms. But if your wife wants a new car, she's talking about a brand new car, I wouldn't worry about the depreciation if the plan is we're going to buy this new car. We're going to keep this new car for its useful life so that whatever you buy, you're going to keep for the next 15 years or something along those lines or however long you get out of it. Because then you've actually gotten the best deal. You got to a point where you paid the car off. You then had no car payments. You didn't have to live up to somebody else's lease terms. You got the age out of the car. Now, if she's going to say, I want a new car, and then she's going to go, I really like having a new car. I want a new car every couple of years. Then the question would be, are you leasing versus buying? Because you may not get your depreciation out of it if you buy. But again, the lease terms, it's going to depend on the terms of the lease and whether or not it works out. So it's not completely clear cut. But if all you're worried about is, if I buy a new car, it's a ripoff because you don't get your value out of it, that's about how you use the car. Lay out your car situation and think about it for the next 20 years. So, for example, in the case of Gail and I, there will come a point where we probably don't need 2 cars because I drive so little. If Gail were to get to where she's not going into Boston, we'll quickly get to where we go, do we need to replace a car? Now, in the town I live in, where you take your car to the dump because you're tossing out your trash, I don't have trash service. I take my car to the dump. I might want to keep my old beater. There's a lot of people here who have a dump car. That's a separate issue. But maybe don't look at it just as what's this vehicle. Maybe look at what's your vehicle situation for the next 20 years. Because you could buy this car and potentially keep it for 10, 12, 15 years, in which case you've gotten all your value out of it and it's just fine. Or you could be in a situation where you are saying, hold it, what's going to happen when we reach retirement age? Are we going to need 2 cars? What are we going to do? And I know plenty of people sit there and say, I'm always going to want to have my own car and have my independence and my freedom. But if you're looking and making a financial decision, I mean, I know when my parents went from 2 cars and my mom was completely independent, etc. In fact, she was driving long after my dad had stopped. But I know when they went to 1 car, I know that Gail and I look at it the way my sister and brother-in-law did. My sister and brother-in-law got to where they were moving and they said, we're only going to need 1 car. And now, because they live in a city where they could just as easily take an Uber or a taxi, and they can also rent, zip cars and things like that, they're questioning whether they're going to keep the car that they've got. Take that long lens view, put that into play here, but don't think that, buying a new car it's got to be the worst decision. Buying a new car, you need to look at it differently. I have a friend who she basically buys a new car once every 12 to 15 years. She buys a brand new car and she's always been very, very happy with it. She's loved the cars that she's bought. She hasn't bought them till she found something that she really loved. She negotiates a hard deal and then she's like, yep, and now I've got a new car and I basically drive that out. That's not a bad deal. It is not. So don't think that just because I'm buying a new car, I'm getting ripped off. That's not it.
Baby, you can drive my car.
Yeah. You can drive an old car like mine, and I understand, Pete, why you don't necessarily want to buy a new one, but at the same time, if it's what's going to make your wife happy, remember that there's some value in that, and just have a discussion of what it is that she wants and what it is that you want, and then decide. I used to be exactly where you are, and I would say I'm only ever going to buy a used car. I've only bought 1 brand new car in my life. And that was many, many, many years ago. And I love driving an old car that I don't care about. To me, a car is a use asset. It's not a status symbol. It's not any of those other things. But I'm buying something that I can live with, but I wouldn't mind having something nicer. I can see where she's coming from. To that end, you can get that nicer thing, do it the right way, and it can still make financial sense. You just have to go into it thinking about the right way. So I don't know if I changed your mind, Pete. Let me know. For everybody else, if you're out there and you got a question, Chuck at MoneyLifeShow.com. And if you'd like to hear me talk more about stuff like this, ask that too, or just let me know, because we can get experts on, and we will when the time comes that I'm actually replacing my car. But right now, we'll be back to the experts in just a second. Mark Hamrick will be here from Bankrate.com when we come back. This is Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Now Money Life looks at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data. It's going to help us understand what people are doing for, with, and about their money. And today, what we're finding is that workers are, perhaps not surprisingly, behind on their retirement savings. It is the latest retirement savings report out from Bankrate.com. It was released on a day ago on the 24th. And if you want to find it, well, it's Bankrate.com, but go find the full link, the direct link that will get you there. It's in our show notes or where you find my guest. Mark Hamrick is Senior Economic Analyst and Washington Bureau Chief for Bankrate.com. He's also a former president of Cebu, just like me, and we're old friends, and it's always fun when I get to say, Mark Hamrick, welcome back to Money Life.
My great pleasure. Good to be with you, my friend. Thank you.
You know, as I read this and I looked at the survey, I did think of something that is maybe a little bit different in this study, because we're never going to see a study that says, hey, Americans are caught up on retirement savings. Who needs Social Security anymore? Like, that's never going to be a thing. But we have seen a market that's been on an incredible run that has gotten to record highs and keeps pushing them higher. And we've had 3 phenomenal years where if you were playing catch up, you've done some catching up. But apparently, it's not even close to enough, right?
I think that's right. And, if there's a long game, it is saving for retirement, right? And so, we can acknowledge what, let's say, the historical patterns are for stock market performance, because primarily people are going to be exposed to S&P 500 funds, and obviously however they, manage that around the edges is another question. But we're really talking about, as you know, Chuck, structural issues here. And what are structural issues? Those are really long term, being the opposite of cyclical, where it's short term. And so, you like it when the cycle is your friend, you like it when the short term is your friend, but in the long term, it may not be your friend. And so, what are those structural challenges, broadly speaking? Well, you can say historically high inflation, sort of draining people's financial resources over the past nearly 5 years now. You can say the reduced reliance or availability of pensions being another structural challenge is young people raising their hands and taking advantage, and to some degree being taken advantage of, with respect to student loan debt. So, there are many things that are, you could say, in conflict. But I would say, if there's one main takeaway here, and I'm not trying to like race to the bottom of the list of questions, but maybe to help people elevate this in their thinking, is this isn't something to put off into the future to problem solve around. If anything, both for younger people as well as the people who are thinking about retirement being not so far off in that proverbial offing, prioritize, problem solve. It's like dealing with a bill collector. If you don't answer the call, the worse it's going to be. This is a kind of a bill collector calling, saying, you need to save for retirement.
Not only that, again, let's look at the phrasings here and the way things were worded. Nearly 3 in 5 American workers say they're behind on retirement savings. And when I was reading this, it's more than 1/3 of American workers, those full-time or part-time or temporary unemployed, expect to need $1 million or more to retire comfortably, but only 50% think it's likely they can reach their retirement savings goal. Well, one, if you started late, you have much less time, right? You and I both know, especially in these days where there's so much talk about the, financial independence, retire early movement, where the idea is, save like crazy. And I know a few people who got into their 30s and were like, yep, if that just keeps growing, I don't need to do any more saving because I've done enough when I was young, which you can't do if you start saving in your 40s, et cetera. So to your point, don't put this off. But also, I question when people are saying, I don't have enough to reach my goals, or I'm not going to be able to reach my goals. Do they fully understand the power of compounding, what it's going to do over the years they've got left if the market just does average returns, and how to set that goal? Because I'm not sure that they understand the target, which may be part of this problem too.
1000%, which is to express something that is at some level mathematically inappropriate, but which might align well with this. But my point, to your question or to your point, is that, we asked people how much they think they need to retire. And the answers there are very illuminating as well, because you can argue, number one, 28% saying don't know. That is a bad answer. It might be honest, but it's a bad answer, because they apparently can't even guess. And 51% saying 500,000 or more, where 34% say more than 1 million. To your point, Chuck, when we don't need to get into this now because it's a more complex issue, if people understood what the implications are from having only, quote unquote, $1 million in the account at the time of their retirement, how much they could reasonably withdraw from that account on an annual basis, they probably would be concerned. So a million sounds like a great number, but for many people, that isn't going to be enough.
Yeah. I think that that's a part of that problem as well. You can be undersaved, you could be under gold, or you could be the other way. I'm never going to reach my goals because I set it so high because I think that I'm going to need more than I do. And even the thinking about that, some of that stuff, not just for the consumers, but you and I know, talk to people in the industry, Bill Bernstein, who came out with the 4% rule, has now modified it and said it's more like 5%. Okay, then you can spend a little bit more, which means you can change your goals a little bit.
Yeah, but you know what? To do the math, I guess I said I wasn't going to go there, but 4% of a million is $40,000. 5% of a million is $50,000. Aren't you really going to have a great time with using an annual income of $50,000? A lot of people, that isn't even going to be, enough. Obviously, they're going to count on other tools such as Social Security, but it obviously depends on the income they have to replace and what they anticipate their expenses to be.
Yeah. And it's a lot of things along those lines that those things are not necessarily done here. What I also didn't see, and I don't know if it's because you guys didn't ask the question, but that I'm always surprised about these days is that I didn't see people saying they're much worse off now than they were just a few years ago because inflation's gotten worse, et cetera. Like I don't see anything here that suggests that Americans, in spite of the headline risks that they're all talking about, there's that disconnect that we see between sentiment and where things really are. I didn't see people sort of bringing that bad emotion into this survey and going, yeah, I'm a lot less likely to make it now than I was a couple of years ago.
And you're right. That's not a question we asked, and we asked maybe flavors of that in other surveys, but there is something that's in the neighborhood of that where we ask people, well, what are you saving now relative to a year ago? And 36% said their retirement savings now are about the same or is about the same as a year ago. 17% said less, 24% said more. And this is the one, again, tangential to the don't know how much I need and may not going to prioritize that in the near term, is 23% said they didn't contribute last year and they're not contributing now. And that's sort of you could make an argument that's the lost generation when it comes to saving for retirement.
Is there a logical solution or help, or are we going to have to live through a generation of people where they go through this and they somehow manage to teach their lesson to their children the hard way? Like this, you don't want this to happen to you. You need to be doing better.
Well, I think, first of all, the fact that more senior Americans in the workforce, and by the way, that's the population that was expressing their answers here. It's Americans who either currently working or unemployed and seeking work. More senior American workers identify this as, more often being behind. And therefore, my sense about that is that that's because they're figuring it out at this point. And, if you're a member of Generation X, where that's age 45 to 60, 69% of saying they're behind, 69%. That's a lot. And that means they have less time to work with. So the fact that we're discussing it, we're hoping helps to elevate it as a priority. And then, there are all kinds of ways to problem solve, save more, delay taking your Social Security benefit, work longer, or at least work somewhat longer, escalating your participation and contributions in a 401k program, and working with perhaps a fee-only financial planner. But if you've got a workplace consultant, such as a 401k plan administrator, you just pick up the phone and talk to them, and that can be free advice. And obviously a lot of information, including our retirement calculators at bankrate.com.
Yeah. And that point you made, I don't want to have it be lost that the audience here, that the survey participants were people who are working full part-time or are looking for work, which is making an assumption. And it's not necessarily always a great assumption, but I think it is in this one. The people who are not included are the ones who have retired, who presumably had enough money to retire. Because if they didn't, they'd still be in one of those other categories, wouldn't they?
Yeah, or obviously forced to retire and not having any other options. And so that's why we do select this as the group that we think has perhaps some of the most relevant information to share.
Well, this one is definitely relevant to us and everybody else because everybody's trying to make their retirement numbers. And you should see what other people are doing or not doing because it's going to help you get a better handle. And it may convince you to do those things like get to the planning, stage and do the things you need to do. Mark, great stuff as always. I'm sure we'll talk again soon.
Always a pleasure, Chuck. Thank you so much for having me.
That's Mark Hamrick. He is the Washington Bureau Chief and the Senior Economic Analyst for Bankrate.com. You know the website. Again, go there directly for their retirement savings report. It just came out. Up next on Money Life, Nate Thooft from Manulife Investment Management. He's here for the big interview when we come back. Welcome to the big interview on the September 25th edition of Money Life. Joining me now, Nate Thooft. He is Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. If you want to learn more, manulifeim.com. Nate Thooft, it's great to have you back on Money Life.
It's great to be here, Chuck.
Let's start with a base case for where we are now, but also with an eye towards where you would have expected us to be right now. Because frankly, you and I haven't talked for a little while, but the market is not that far off from what folks were thinking we'd see back at the beginning of the year. We're maybe ahead of it a little bit, but not way off. It's just how we've gotten here has been the part that was really unexpected. So where we're at now, where do you think we can go, and how different is this from what you were expecting 9 months ago?
Yeah, I think that's a great point. We do definitely think that the market has a bit more upside here, but at the same time, the path of how we got here has been a bit surprising to us. I mean, we didn't get pulled into the narrative of bringing down our expectations too much during the March, April timeframe where there was a lot of concern around tariffs. We kind of were like, this is going to settle. This is going to work out okay. And we did add some risk as the markets corrected in that time. But by no means did I expect to see this type of rally from the bottom that we've seen over the course of the last few months. So this has definitely got a little bit ahead of our expectations. But at the same time, the character of why we've seen this type of rally and some of the underlying fundamentals that have driven it are actually pretty positive. And the broader sentiment and the broader technicals of the market still remain in a pretty good spot. So we do think we'll see higher highs. I get more worried as I look into 2026 about what's the next catalyst beyond the end of this year. But at this stage, for the next few months, I still feel pretty comfortable being a bit risk on, and we maintain a modest overweight to equity risk in our portfolios.
Last time we talked, you guys were overweight equities. How long do you stay overweighted in equities at a point where valuations have gotten very rich? And when we get to record highs, does that normally make you pull away from equities, or at least become more selective somehow to say, let's get away from the things that are at the top of the valuation chart?
The one thing I always tell folks is, while valuation is an important tool when we think about fundamentals and investment process, it's one of the worst timing tools out there. So I don't think valuation is a particularly good argument or catalyst to say, we should be moving to underweight of the markets. Valuations is not what will cause the next correction or the next downturn. It's going to be some other event catalyst that drives it. And valuations is just one of the metrics that will be alleviated when that happens. And so we don't tend to look at valuation on its own as a timing tool. Where I do get a bit worried, though, is there is a level of complacency in the market right now. And we are starting to see that, particularly with retail investors to some extent. We're seeing it with other indicators where the volatility levels are pretty low and people are just kind of riding the wave. And that worries me to an extent. But at the same time, it's hard to ignore the fundamentals. And people will ask me often, hey, are you worried about the valuation of U.S. equities? Yeah, I am. But at the same time, I look at, is this another tech bubble or is this another pre-financial crisis? I don't think so. You look at the drivers of how we've got to these valuations, and you look at the underlying fundamentals and the quality and the consistency of the earnings that are driving those and the overall margins that you're getting from some of these names, they actually do support higher valuations. And I think it's difficult to compare today's valuations to the long history of valuations because tech companies in particular, they do tend to underestimate particularly balance sheet type of indicators. And so while we think about valuations as being expensive, it's not an apples to apples comparison versus historical valuation metrics. And that's not to dismiss the fact that things have gotten a bit lofty, but there is some validity to the argument that valuations are not as crazy in absolute terms versus comparing it to a history of relative valuation.
What are the areas that you are leaning into? I mean, we have seen so much of the AI trade and it's been driving things. Are you still all in on AI, or are you more AI adjacent, or are you, while the AI train has been rolling, I'm more interested in the stuff that's been left behind? And what would that be?
We are definitely looking for ways to recycle some of our wins and to broaden our exposure beyond just the secular theme of AI. Going back to my comment about the markets are feeling a little bit complacent, one area of complacency is certainly with the AI trade, that every news announcement comes with more upside. So that worries me a little bit. So we are looking for things that we can rotate into or recycle some of the wins we've had, just as many of our clients have had wins when it comes to exposures in tech. We are looking at areas like financials, which have actually worked really well for well over a year at this stage. So it's actually been a really good trade already. But I think there's more room for financials can continue to do pretty well, particularly from a U.S. perspective. Another area, which is a bit more controversial, is some of the healthcare names. This is an area that's been woefully unloved by the market. There's a lot of reasons for it. Some of it's regulatory risk. Some of it's related to Medicare dynamics and the payments. Some of it's related to just, you can't like everything in the market. And the healthcare area has been one area that's been very unloved. But some of these names are now pricing in pretty much worst case scenarios. And they do have decent dividend levels. And they actually have decent earnings expectations looking out the next 12 months. So we do start to nibble at some of the more healthcare area of the market as a source of additional diversification in portfolios. The last thing I would say, and I think this is important, earlier this year, we did take advantage of upgrading our view on many of the non-U.S. markets. And I'm not here to say that the non-U.S. markets, particularly Europe, are going to be in the next secular 10-year trend. They're not. The demographic issues and the broader concerns about Europe are still in place. But in the shorter term, there are areas outside the U.S., like Japan as an example, parts of the EM space, even selective, particularly the peripheral areas of Europe. We do see more upside potential in those areas looking out the next 6 to 12 months relative to some of the opportunities that we might find inside the United States.
There are those folks who believe that the international opportunities are played out, that we've seen this fabulous rally, but that it can't continue. Do you worry at all, since we haven't really seen the impacts of the war and the geopolitics that have been happening around the world hitting home yet in most international stocks, that there's still a shoe to drop there? If you're not ready to get off, like some people are, how long do you think it continues?
I think there's always a level of skepticism about non-U.S. markets, given the fact that most U.S. investors have been burned by it for much of the last decade plus, because the U.S. markets have done so well. So there's a high level of skepticism about, can non-U.S. markets continue to perform well? And I tend to agree with some of that skepticism, particularly as it pertains to Europe. But when you look at some of the Asian economies and you look at some of the opportunities there, I think there is a potential for us to have a sizable leg or room for us to continue to grow in some of those markets, and the equity markets to do quite well. I'll use China as an example, which is probably one of the more controversial areas. When you think about what's driving the U.S. market today, a lot of it's been AI related, and a lot of it's been the big Mag 7 tech type of names, which are great high quality companies, but they are pretty well priced at this stage. But you look at their comparables in China and you look at the broader industry trends that have happened in China, you haven't seen as much exuberance, although you're starting to see it in the last month or so, when it comes to AI build out and AI CapEx in the China region. And they have just as many good companies that can benefit from that. And given the world order is now basically bifurcated us into the Western aligned and the Eastern aligned, the Eastern aligned is going to have to build out AI infrastructure no different than the U.S. aligned side of it. And that's going to require a lot of spending, which is going to require some companies to be big beneficiaries of that. And we haven't seen that to the extent that we have seen in some of the names in the United States. So I do think that's part of the thesis is why you might continue to see, particularly in the tech-heavy Asia economies, like a China, like a Korea, like a Taiwan, that there's some real opportunities for further upside in those economies, and the valuations are not as crazy as you see in the United States.
Let's turn from equity markets to fixed income markets because everybody is focused on rates and what's been happening with rates. And I certainly don't want to ignore that. But I think the focus on rates has also meant that they've ignored what's happening with credit spreads. And that's telling a story too. So, which to you is the more important story right now? The story we're getting on rates and the start of a rate cut cycle, or what's been happening with credit spreads?
I think it's both. I mean, honestly, if there's one area of the market that's not pricing any sniff of a recession or slower growth profiles, it's the credit market. Now, you can take that two ways. You can take that, wow, it's really missing the mark, and we're not seeing any evidence or pricing changes to reflect that. We do have some economic headwinds, and we do have some slower growth and job concerns, et cetera. But the credit markets are priced for perfection. And normally when we think about fixed income, that's an area that you're trying to, provide some level of protection for our clients. And so what we have done on the credit side is we have been increasing the quality of our exposures, and we have been selling high yield or below investment grade credit to buy better quality investment grade, because the reward that you're getting or the additional potential returns you're getting from taking on that additional risk is just not there as it historically is. So we'd rather be high grading our fixed income at this stage while still taking some risk on the equity side. But at the same time, there are areas of fixed income in the risk markets where we still see opportunity, particularly in emerging market debt, both dollar-based emerging market debt as well as the local-based emerging market debt. Given the balance sheets of some of the countries, we prefer EM debt over, let's say, high yield. While they have similar risk levels, the opportunity set, the yield and return potential, we believe is better in emerging market debt. On the duration side, we still remain underweight duration, particularly as you go further out the yield curve. We do have worries that we're still massively underpricing term premium, and it's not worth the effort or the risk to go further out on the yield curve. And so we're more focused on the belly of the curve and inward as you're getting fairly decent yield still, and you don't need to take that extra risk of duration, because when the Fed continues to cut, we likely are going to see a steepening of the yield curve, and the long end of the yield curve is not going to go down much as the short end of the yield curve. So we think the real opportunity in fixed income is to stay within the belly of the curve and inward, and then also high grade the overall credit quality of your fixed income portfolio.
We've come this far, and we haven't really talked about gold. Gold has been more of a geopolitical hedge than an inflation hedge, because inflation, while sticky and higher than the Fed's target, has not been at the levels that make gold a great inflation hedge. But it's been that good hedge for geopolitical risk. It's done really well in the face of what's been happening with rates and the rest. Is that about to change, or are you still on the gold wagon as well?
Gold is a fascinating asset because there is no really good way to measure what is the appropriate value of gold. And gold tends to trade on different themes at different times. And I agree with you. One of the reasons why it has done so well is around geopolitical dynamics. But just as importantly, it's trading well because there's worries about fiat currency and the value of fiat currency. And then you can also add on things like demand and supply dynamics, and you can also add on potential inflation risk concerns. So there's a lot of underlying drivers right now that are still in favor of gold. But relative to historical standards, the move we've seen in gold is way overdone. Now, I'm not saying that it's not going to continue, because we started this year with a price target of 3,200 on gold. We ran them raised it to 3,500, and Lord and behold, it just keeps on going. Is 4,000 a possibility on gold? Absolutely. Based purely on sentiment and technical drivers, we could easily get to 4,000. I wouldn't be adding to gold at these levels. I would be, trimming some of the wins. We do still have some exposure. We are still technically overweight gold because it's not part of our benchmark. So any exposure is an overweight, but it is gotten a bit overdone. But this is a type of asset class that can be very sentiment driven and very technical driven. And it's really hard to say when is the top going to be. And if anything, if you're a technician and a sentiment focused person, individual, this run could likely continue on for the foreseeable future. Eventually, it's going to crack, and this is going to act more like a risk asset versus a risk-off asset. So that's the worry. Folks that are expecting this to protect you on the downside, I don't think that's gold at these levels.
What about alternatives for you at this point? I mean, given everything you've said, it doesn't sound like I need to go to alternatives to be able to find good opportunities. So where do alternatives fit in?
I think where alternatives still fit in is particularly going back to the comment that we aren't big fans of longer duration fixed income. We always have historically, as investors, many investors anyway, have relied on long duration fixed income as a safe haven in portfolio. So when things go bad or when the unexpected happens, you could rely on long duration to help you out in portfolio protection. But given some of the broader concerns we have about debt levels, given our concerns about just the supply at the longer end of the yield curve, we still think long duration serves a purpose in portfolios, but the efficacy of that long duration may not be as good. What do I mean by that? We might see more years like 2022 where long duration fixed income, the correlation versus equities did not do what is normal, as in they both went down at the same time. We might see more episodes like that. So relying on long duration as your kind of safe haven or your insurance policy in portfolios as the only exposure doesn't make as much sense to us. And this is where alternatives can still play a role, particularly certain types of alternatives that are more defensive and are more non-correlated to traditional assets. And so that's where I think it's important to look at different types of private assets and different types of liquid alternative assets that can still serve as a good diversifier and downside protection vehicle when things aren't going well or that inevitable surprise happens for the markets.
We've come this far and we've talked about assets, but we haven't necessarily talked about the economy in general. We've talked about valuations, things along those lines. But you can have all these things happening with or without a recession, a hard or a soft landing, et cetera. So what is your take on what kind of landing we are or are not going to have?
It's a tricky question right now because when we look at our base case scenario, we think the U.S. economy and the global economies in general are going to be able to push through this kind of lull or weak patch that we're currently seeing. And the premise for that is, why are we seeing job weakness right now? Well, the reason why I think we're seeing job weakness right now is there was a bit of paralysis that happened in that kind of March, April timeframe where companies did not know what to do given all the tariff uncertainty. And so they kind of put things on pause and they pulled back from planning and they became a little bit indecisive in their decision making. Well, Lord and behold, we pushed through the tariff questions, although there's still some open questions out there, but things aren't as bad as people thought. The overall tariff rate isn't the worst case scenario. There's a lot of exemptions to the tariffs, particularly for certain countries. So while the tariff rate has certainly gone up, we now have a little bit more color and a little bit more certainty around what the outcome it was. And so the planning by companies has started to improve a bit. So this lull is a reflection of that paralysis that happened in that kind of March to April timeframe. But looking forward to the next 6 to 12 months, we're going to start seeing hopefully some better corporate management and corporate activities that are now being able to be made because the uncertainty to some extent has passed. And so our expectation is we'll kind of muddle through this weak job period and this kind of slower growth period, and we'll actually see some improvement in that over the course of the next 12 months. That's a more positive perspective, right? And that's our base case. But I would only assign maybe a 60% probability to that base case. That means there's another 40% probability where the weakness in job growth is an early sign of recessionary risk. And that is more troubling. And that's not our base case, but there is a scenario where this is going to not end well. And that's the risk that we have on the table. But right now, we're more of the view that we will muddle through this and we'll have a decent growth environment from an economic perspective, helped supported by the fact that we'll have a Fed who is cutting and we have generally better growth from a global perspective as well.
In all of that, you're now at a spot where presumably you're starting to get ready to make your forecast for 2026. We started this interview talking about how this year has lived up to expectations on the return side, but not necessarily on the journey that we took side. So given what you see, it sounds like we're setting up for a fairly benign 2026. How easy or hard is it to say that when you know we've had several good years in a row and no one in the market believes like, hey, trees grow to the sky without problems. Can we continue this rally kind of indefinitely, given everything that is a concern? Like, do we just keep climbing this wall of worry for the foreseeable future?
I don't think so. I mean, I'm more worried about next year, and I'm not worried because I'm worried about the economy for next year. As I just said, I think the base case for the economy next year is we actually might see some improvement versus the current numbers. But I'm more worried about the market next year because I'm worried about what is the next catalyst. This year we've had the tariffs kerfuffle, and then we had basically the market start to accept it, and it wasn't as bad as we all thought it was going to be. And then we had these compromises that have happened with certain countries. Now we're kind of all playing on the card that the Fed's going to cut, and they might have cut more aggressively than some had anticipated, and they're kind of banking on that. But what is that next catalyst next year? I'm not convinced I know what that is, and I don't think the market knows what that is. We might get into a situation where there's nothing to market to look forward to, and it's priced in most of these positives by the time we get to like March or the middle of next year. So I'm a little bit more worried about the market that we're going to get all this upfront run up, given the positivities and some of the underdriving themes that are happening right now, but it's going to hit a wall of exhaustion, and there's not going to be a new catalyst for the next leg up. And that's what I'm worried about, particularly as you get into the second quarter, the latter part of 2026. I don't see what that next catalyst is to drive markets. And it might just be that we get fantastic growth and earnings continue to hold up really well. That's a possibility, but I think it's too premature to expect that at this stage.
Nate, really interesting. I look forward to getting a chance to chat with you as we watch how the forecasts are made and as they play out into next year. But thanks so much for the time you've given us today.
Thank you so much for having me.
That's Nate Thooft. He is Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Go to manulifeim.com to learn more about the firm and what they do. And we will be back to put a bow on this show. Stick around. You don't want to stop before we reach the finish line, so don't. We'll finish it out in a moment.
Hi everybody, it's Rob Floyd, MoneyLife's executive producer, and this week we have a contest for Jillian Johnrood's book, Retire Often, which was featured on the September 10th show, right before Chuck headed to FinCon. The book is all about how people can take short or mid-range retirements to pursue their passions and recharge their batteries and change their lives. In the same way that it's never a bad choice to take a break, there are no wrong answers to the contest this week, because all you need to do to enter is send us your 2 most appealing mini retirement ideas. Now, Chuck says you're not allowed to say, I'd quit my job and do nothing. We're looking for what you would do if you could retire the way Johnrood suggests, taking a break for a month or a year to try something new, pick up a new skill, pursue a passion, and so on. Send your most interesting retirement ideas to chuck@moneylifeshow.com. And so long as you have 2 ideas for your next retirement, you'll be entered in a drawing to win the books. The deadline is Saturday, September 27th at noon Eastern Time. Please put the word contest in the subject line of your entry, and maybe your next retirement can start with reading the book you win.
We're back to wrap this one up. Hope you enjoyed it. We don't have a lot of time, and we have a lot to get through because today may have more holidays than any other day of the year. But tomorrow on this show, Stephen McKee from the No Load Mutual Fund Selections and Timing Newsletter returns to the show, but not to talk about ETFs specifically. He's going to talk technical analysis with us. We'll have John Cole Scott for the Navigator segment, and Jim Besaw from Gen Trust will make his debut in the big interview. So that's coming here tomorrow. Meanwhile, if you are looking for something to celebrate, there are more things you can celebrate today than like any day of the year. So it's National Daughters Day. And as the father to 2 daughters and the stepfather to 2 more, yes, celebrate your girls. Although I celebrate my kids pretty much every day, but anytime I get an excuse to call, I'm going to do it. It is National Tune-Up Day. Yeah, your car should be tuned, etc. But then we get into a bunch of different things. It's Open the Magic Day, which is about reading and trying to help with books, like do books with your kids or your grandkids or whatever, but also yourself. Open the magic. But it's also National Comic Book Day. So the book you open could be a comic book. And if you want to tell a story,
I got an unbelievable story to tell you. Absolutely incredible.
Then do it with math, because it is Math Storytelling Day. Or maybe do it with song, because like it's National One Hit Wonder Day, and there's always a good story behind a good one hit wonder, and sometimes it's kind of a good storytelling song. But if you don't want to do a one hit wonder thing, it's Binge Day. Yes, Binge Day is held late in September because that's now when the new seasons of shows come out. So you can either binge your faves because they now release all the issues pretty much all at once instead of having to wait for the next one to come out, or you binge the last season or 2 seasons of some show that you're going to start to watch that's now on broadcast. You can do that too. It's also National Research Administrator Day, National Psychotherapy Day. It is Remember Me Thursday, which is about dogs or cats or animals. They, remember them, that there are those at the shelter, etc. And then maybe more serious than all of this, at least because it affects me personally, it is International Ataxia Awareness Day. And my neighbor, Michael Equi, who was my neighbor for more than 20 years, passed away a few years ago, battled Friedreich's ataxia for decades. And you would have thought it was a stroke and the rest. And the more I learned, the better I was able to be a good friend and good neighbor. And so, and it was funny because when Michael passed, not everybody knew that that's what had been the issue that had relegated him to a wheelchair and the rest. So again, it is a case where awareness does help. And you don't know who's got it until you meet somebody. And on the food front, it's National Cooking Day. And what should you cook? Well, you should make quesadillas because it's National Quesadilla Day. It's National Lobster Day. And then, ironically, when you've got lobster, it's Crab Meat Newburgh Day. Not Lobster Newburgh Day. That's a different day. It is Crab Meat Newburgh Day. My guest today, Todd Rosenbluth, Head of Research at Vetify. Go to vetify.com for more details. Mark Hamrick, Washington Bureau Chief and Senior Economic Analyst at Bankrate.com. The direct link to the study we talked about, the Retirement Research Report, in our show notes on our guest page. Nate Thooft, Chief Investment Officer, Senior Portfolio Manager at Manulife Investment Management, manulifeim.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from one of my favorite folks to study, John Maynard Keynes, who said, "There's nothing so disastrous as a rational investment policy in an irrational world." Well, I'm not sure how rational the world is, but I know that to stay rational with your investment policy and your strategies, you have to keep things in perspective. And that means you should remember, until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Forget it, it's past history.